Hi, in this video, I'm going to summarize the learnings from the tutorial that you've just gone through. I want to quickly show you the key trends, the patterns that we have already discussed, but I want to summarize those for you. Now, if again, going back to the four key terms in accounting: assets, liabilities, incomes, and expenses. As far as assets are concerned, you are either going to purchase the assets, you're going to sell the assets. One more thing that could happen is you charge depreciation on the assets. So, whenever an asset is purchased, the asset is going to come in. So, asset account debit, and you are going to pay for it. So, to bank account. If you do not pay for it, instead of bank account, you could write the vendor's account, because the vendor becomes a liability for you now. So this is the purchase. When you sell any asset, the sale of asset, the transaction reverses. So you now receive money in your bank account, and instead you in place of the money, you give away your asset. The entry reverses. Instead of debit, asset is being credited. And if you don't get the money, you say, you write the name of buyer, so buyer's account, because he becomes your debtor. Now you have to recover money from him. So these are the two transactions: purchasing the assets, selling the asset, purchasing them in cash or purchasing them on credit, selling them in cash or selling them on credit. The other transaction is about depreciation. Whenever depreciation is charged, you have depreciation account debit, and the asset goes out, asset account credit. Again, it is similar to the sales entry, because asset goes out. Here money comes in, no money comes in. You have converted that part of asset into an expense called depreciation. Okay, so this should summarize the different transactions with respect to assets of the business. Largely there will be other transactions, but purchasing, selling, and charging depreciation on fixed asset is taken care of by similar transactions. Let me go on to the liabilities now. When you raise a liability, for example, a bank loan is raised or capital is raised, you get money against it. So bank account is debit, and the name of the liability is written here. So liability account is credit. Now liability account can be bank loan, it can be shareholders capital, or it can be a vendor, whosoever has supplied this money or any other resource to you. So this is typically how liability is going to be raised, a transaction. And then when you pay back the liability, the transaction is reversed. So liability account is given an opposite treatment, which is debit, and you pay for it to the bank account. Okay. Another way that we saw the liability could be created is when expense becomes overdue. Expenses become overdue. When expense becomes overdue, now I'm just replacing this. Instead of paying for an expense, you have so for example, rent. No, let me write expense only. Expense account debit to outstanding expense. Outstanding expense account. This is another way of raising a liability, generating a liability. So these two, number one and number three, are also similar in nature. And finally, when you pay them back, you have outstanding expenses debit to bank. So liability debit to bank, bank debit to liability. I'm just trying to show you a variation that it is possible that you're not getting the money, but that money is becoming just due. So that is a summary of how transactions relating to liabilities are written. Then expenses which are paid or they become due. So when you pay the expenses, you have name of the expense. So expense account debit, and you pay for them through bank or cash. Okay. If you don't pay for them in bank or cash, then you have an item called outstanding expense. We just saw it in the previous slide. So outstanding expense is created as a liability. So all the expenses, regardless of what the name or the nature, you have expense account debit to bank account. That's how all expenses are going to be recorded. Then you have incomes received or accrued. Accrued meaning became due, not received. When you receive an income, you have money coming in. So you say bank account debit to name of the income account, to the income account. All right. Now, money could be received or not received. If money is not received, you write the name of the receivable, or the party, the customer or whosoever you have to receive this money from. So this becomes, an asset is created in this process. But all income related transactions are going to be written in this way. So that's it. I wanted to just summarize, again relating, linking everything back to the four key accounting terms: assets, liabilities, incomes, and expenses. We went through a detailed tutorial and we looked at the patterns there, and now I have summarized how transactions relating to asset, liability, income, expense are related, are they follow a pattern, and how you could try to think more intuitively about these things. I'll see you in the next video.